Wonderful. Good afternoon, everyone. I'm Andy Byron, a senior advisor and principal at HC Financial Advisors, and we welcome you today to Steve Biggs's 2022 Economic Update presentation. As you all know, Steve is our Chief Investment Officer and a principal of HC Financial Advisors, and will be giving the majority of today's presentation. He will also be joined by Tim Harvey, another CFA, CFP, and advisor, to show a few slides on alternatives and their increasing use in client portfolios. There will also be a Q&A segment after the presentation. Some of you have already provided questions which Steve will address during his presentation. If you'd like to add a question, please do so using the Q&A button on your screen. Abby Hassling, also a CFP and another advisor, will be compiling your questions by topic and providing them to Steve. I know we're looking forward to Steve's thoughts on the US and global economies, current geopolitical risks, Federal Reserve interest rate policy, inflation, and the recent volatility we've seen since the beginning of the year, among other topics. So now let's hear from Steve Biggs.
Thanks, Andy. To share my screen. And yeah, so as Andy mentioned, this is our annual economic outlook and kind of topics we're going to cover here today. So we had a lot of questions that everyone sent in, so thank you for that. A lot of questions regarding inflation, anything from Bitcoin. We had a question on Steph Curry's jump shot. We'll try to get to all of those, but most of those, but probably not all of those. We'll go into markets and stock returns and valuations and the impact of rising interest rates and higher inflation environment than we're used to. Talk about the Federal Reserve, what they're doing, and our outlook for the full year 2022 we're in. And as Andy mentioned, Tim will quickly discuss alternative investments. And then we do plan to leave some time for questions, hopefully a few minutes at the end. If you go to the bottom of the screen, there's a raise hand button. We'll compile those so ask any time, and we'll compile those during the presentation and cover those at the end of the talk. So starting out with the economy, this is what the economy looks like. So the trend growth has been around 2%, and that's about for the last 20 years. So economy really can't grow. The US economy has grown at 2%. It's not really set up to grow much faster than that. If we grow ahead of trend, we kind of run out of resources and it'll put strains on the economy. So if you can see so that's the 2% line, and then everything shut down for the pandemic. And we had one of the biggest recessions since the Great Depression, but it was very quick. So we had a huge drop off in economic activity in 2020, and that came back very strongly in 2021. So we had just, some of the strongest economic growth we've ever seen, but now we're almost back to where the economy would be if we had never had a pandemic, and we'll probably hit that here sometime in 2022. So at that point, economic growth has to slow, and we should be back on that 2% range, which is still positive and probably a pretty good, healthy rate for us. But we don't expect to grow some of that growth we've seen in the past to continue, just because it really can't. What we have seen is a big jump in the cost of goods during the pandemic, and that's really just an increase in spending. That's what has driven the increased demand and the increased costs and all the backlogs we're seeing. So this chart shows spending on goods, so just goods, stuff, not going out to restaurants or vacations. 48% increase from 2009 to 2019, which is almost actually just about equal to what we saw spending growth in the last 2 years. So from the shutdown, obviously the sharp decrease in spending, and we're up 46% since that. So that's, it's not a sustainable growth rate. We're not going to grow demand for goods. We're not going to increase our spending on goods at 25% per year. So that will at some point end or decline and go back to kind of a more normal trend rate. And what's driving that is a few things. So number one is just an increase in disposable income. So that red line on top shows disposable income, and it's increased at a pretty steady rate for the last 7 or 8 years. And then we've got these big spikes, and that's during the pandemic. So, where did that come from? The actual regular income is the blue line. So income is fallen, and that difference, the yellow line, is government transfers to the public, which increase income. So it stayed at a fairly steady level. And that's things like unemployment, it's welfare, it could be Social Security. But that increased during the pandemic. So we had government stimulus checks and we had enhanced unemployment. So that has all run out. We're probably not going to see checks sent out to the population anytime soon because we're running a much more tight economy. So this is headed back towards the trend level. So that extra income is receding and people will have less to spend. The other issue is, people could not go out to do things that they like to do. So you had people, everyone had that extra money that they were spending on goods rather than services. So stuff more like TVs, bicycles, all kinds of things that they were buying because they weren't going to restaurants or going on vacation. So if you look at them together, spending on goods on the left, massive increase, that's starting to drop off, where the services, going out to dinner, going on vacation, going to movies, amusement parks, whatever, that had a much sharper decline and has come back much more slowly, but there is some pent-up demand there. So we would expect that to shift over to spending on services and less spending on goods. And there is actually, once we get through this backlog, it's a question of when, not if. There could be a glut in some things, which would put deflationary pressures on the economy. So, so this is something that will overall ease. There could be some inflation in that services end of it, but that is less important to the economy than kind of the manufacturing economy and the goods. If you try to go out to, say, dinner on a Saturday night and the restaurants are full, you'll probably just go the next week, or you'll make reservations further ahead next time. And what does that look like? So about every so often I fly from San Diego to Oakland, and if you stay on the right side of the plane towards the end of that climb, you go over Long Beach, and that picture on the left is, I used to try and count all the container ships out on the off the port of Long Beach, and it got, I think I capped out at about 50. It got too hard. So there's a satellite image to the right, but that's what we've seen. It's just a big backlog. It takes a lot longer to get products now because they don't have the bandwidth to unload all those ships, and that's due to a 20% increase in demand for imported goods from Asia. And again, this is, this we expect to fade. It's not with us for the long term. We have already seen, this is what it costs to ship containers over. That's started to decline. We're starting to see some easing there. So it could be an early indicator that some of this backlog is going to clear out. It'll be with us for a while, but I think we have probably seen the peak there. Inflation, as far as what producers are paying to produce stuff, that's kind of a early indicator. And then there's what consumers are spending. So these charts are, we get these from Carlyle, who's a private equity firm that we work with. They own about 270 companies. So they kind of get data from there and to try and gauge where the economy is going. Their indicators are showing certainly starting to decline in the producer price index, and the actual data has shown that as well in the PPI index, and that is starting to transfer over to the consumers. So we think that inflation in goods is really peaked, and probably not going to be much of an issue in 2022 overall. But there are a few things that will keep inflation higher than what we were used to over the past decade or so. I mean, we've had extremely low inflation since the financial crisis. So rising wages, we've certainly seen that over the past year or so. That's probably likely to continue. We did lose some workers during the pandemic. It's estimated an extra 2.4 million people retired and left the workforce than would have been expected over that 2-year time period. So most of those probably not going to come back into the workforce. At the peak about a year ago, there was about 4.8 million workers that stayed out of the workforce because they had concerns over COVID, didn't want to get sick, things like that. There was enhanced unemployment benefits. Most of those have come back. There's still about 1.7 million people that were short, and some of those should certainly be expected to come back to the workforce. There's probably some that maybe have the financial cushion and change in lifestyle that may not. But even if we get another million of those into the workforce over the next year or so, it's not going to make a huge impact on the labor shortage. We're still well short of what we need to staff the to staff all the positions. And that's what we've seen in job openings. So reason wages are rising, there's a lot of open jobs that people can't fill. So that number on the left, well above job openings at 10.5 million right now. That's well above anywhere it's ever been since this data series has been monitored. And and on the top right there, amount of people quitting their jobs are the Great Resignation is what you hear. That's it's a real phenomenon, and that's people are turning over. They're going to find higher wages. Probably not a lot of people leaving the workforce now. I think more people coming in, but I think it's people that may have wanted to leave their job during the pandemic, but but held off because of the situation. So there may be some pent up demand, and then there's people looking for new opportunities, either career change, better work environment, more flexibility in their work schedule, all kinds of things. So, and obviously not too many people laying off right now. There's a record number of businesses, small businesses that have open positions and can't find the labor they need. But the good news is, slight offset to this is there's been a big increase in productivity since the pandemic started. So this is kind of where we started. A productivity increase had averaged 1% per year. And now over the last 2 years, it's averaged 1.7%. So that is adding to output. So, gross domestic product, the economy is equal to the workforce plus productivity gains, and that's how much the economy can put out. So that extra increase is important. It's most of that's been in things like IT services, professional services like finance and real estate that found out that you don't need to go into the office to be productive. In fact, it's estimated that there's 600 million hours a month as less have been spent commuting. And, we've had 1.4 million fewer cashiers and in-person salespersons that have been replaced by computers. If you go to a restaurant and order from your phone, some of that will go back, but much of it will stay. And that's just an increase to productivity. So people being replaced by, computers, or people just finding ways to work more efficiently. That the pandemic really accelerated a lot of this development that probably would have happened anyway, but we're seeing the benefit of it has ramped up very quickly. And that's, this is what the economy looks like. Goldman Sachs estimate shows that light blue line is where the estimated economic output is now with the improved level of productivity. And this dotted line, or this is where the trend was. So, labor force exits are on there too. So they are thinking that the increase in productivity will almost more than offset the lack of workforce or lack of workers. but we do have a bit of a shortage right now, still driving prices up. The other thing that, that's going to be a lingering impact on inflation is rents. So, we look at, you think of things you need to live on. Certainly, housing is in there. Consumer price index is based on rent, what people pay per month to live. So this chart shows, we have seen a big increase in housing costs, as most of us know, and that takes a while to filter over to what people are paying in rent. So we all know that maybe single family housing is up 20%, but if you're a landlord, you can't just call your tenants and tell them, your housing is more expensive, we're increasing your rent 20%. This happens over several years. This chart just shows that it generally does track housing prices, but at a much more slow rate than what housing prices respond much quicker. So that's going to be a lingering effect that will keep inflation high as measured by this consumer price index. So the overall result is rising inflation. We saw about 7% last year. That's this number here, which is the highest since 1980, but of course, nowhere near what we saw in that kind of inflationary spike headed into the late 70s, when we had runaway inflation. But, we are used to, since the financial crisis, inflation has largely disappeared because people were just not turning over money that quickly. We had this kind of 2% range for some time, which we're used to almost now, almost a zero inflation environment. So, we would expect that as the inflation demand for goods eases, that will back us off that 7% number. We have, still think 3 to 4% is probably where we'll be by the end of the year, at least on a run rate. Maybe the full year number for 2022 is higher, but we think looking forward, 3 to 4% is probably a reasonable. I think we may even get some deflationary pressures from some of these goods categories and goods. A lot of them will be showing up probably in discount stores as we get into the end of the year for next Christmas. But yeah, you do have higher wages that will be with us for some time, as will rising rents. So overall growth looks good. We do have the inflation, but there are a few headwinds that that we need to take into consideration. And the first of them actually is kind of inflation related. University of Michigan Consumer Sentiment Index usually has historically been a very good indicator of where the economy is going. Has done a lot to predict recessions. So the latest reading is pretty low here. In fact, it's about low enough that you would take from that we may be headed into a recession, because when consumers are less confident, they pull in spending. They don't go out and spend money, and that in turn is what causes recession, because less people are spending money and the economy contracts. But most of these, the reason that consumer sentiment is so low is really inflationary measures. When asked if it's a good time to buy a vehicle, that's only about half of the people said it was, or well, I mean, that's not percentage actually. I mean, that's just a huge drop. I don't know why people in 1974 didn't want to buy a vehicle, but it was during a recession, so probably wasn't a good time. And now is a bad time to buy a vehicle because obviously it's simply hard to find a vehicle. They're scarce, and and therefore they're more expensive. So that's a big part of it. Is a good time to buy a house. No, people don't think it's a good time to buy a house, certainly because although interest rates are low, the price is just skyrocketed over the last year. So that's keeping consumer confidence down. Overall confidence, when you ask people if they're going to make more money, that's close to record highs. So we don't think that's a major issue, but it does mean that inflation has come to top of mind of consumers, and something to watch. The other issue we have here is the federal deficit. So, and if some of you remember, after the financial crisis, there was a lot of stimulus from the government, and they were pulling back around 2012, 2013, and we called it the fiscal cliff because deficit spending is expansionary, because if the government's taking in $100 and every $100 they take in, they're spending 120, that's an extra 20% into the economy. So it's kind of a natural process. During a recession, tax receipts fall, and then there's also stimulus to help spur the economy, and the deficit expands. So and that's why we have a federal debt, and ideally, and that's how the federal government, from their standpoint, can increase economic activity. So this chart on the left here shows the federal deficit, and 2020 we had, so almost 15% of the spending was funded by debt, basically, which means they were spending 15% more than they're taking out. That number was very close in 2021, and that's going to have a dramatic drop in 2022. So that's actually slowing the economy, and it's contractionary to the economy because they are taking money out of the economy now instead of putting it back in. That fiscal cliff we talked about, that was all over the news in 2012, barely shows up as at 1.7% was the reduction. We're over here at 8.7%, and then that's about the second biggest ever. The only other time we hit that level was coming back after World War II. Obviously, government spending far less money because it costs a lot to fight the war. And it actually did cause a recession back then with the falling deficit, but it was kind of it wasn't a bad recession because unemployment still stayed very low, and it was more of a shift to spending on other goods. So it's actually, although you spent a lot of money and fueled the economy, spent buying tanks and planes and things of that nature, it was certainly nicer to spend it on other goods that people could enjoy. So it wasn't much of a recession. I think this is going to be a headwind, but not enough to actually pull us all the way back to zero growth. So probably something, I think this has gotten buried a little bit, probably just because there's so many other issues right now, primarily with inflation, primarily with the Fed and rising interest rates, which we'll get into next. So the Fed has been quite clear that they plan to raise rates this year. If we'd had this presentation several months ago, we probably would have said, yeah, towards the end of the year, they'll raise rates. Certain things have changed quite a bit so far. So now consensus, most economists think about 4 rate hikes this year. The Fed has telegraphed that they do plan to raise rates in March. So we expect a 0.25% increase in March, and we'd probably expect 4 of those through the end of the year. Could it be more? Could it be less? I think they have gotten a little bit more aggressive on the inflation question. They kind of took that transitory out of the language. So, I think they are correct on the goods part of the equation being transitory, but there is certainly more inflation out there than anticipated, and this transitory period is certainly lasting much longer. So, they probably will let inflation run a little bit higher than it had been. They had previously kind of targeted 2%, and now they're talking an average of 2%. Really a little more inflation is fine. And given the amount the federal debt has grown, inflation can be a good thing as far as kind of getting that debt under control. And that's what happened after World War II, right? We had higher inflation, and that massive debt that was needed to fight the war kind of became less and less important because it was just a smaller dollar value. So this chart shows the Fed funds rate over the last 20 years. And this could go back even further, but if you look to the left here, the one thing you notice is each tightening cycle is lower and lower, and the lower peak rates and lower bottom rates. So when they tightened towards the end of going into 99, 2000, capped around 6.25%. I don't know if I can even remember 6.25% Fed funds rate. And they dropped that all the way to 1% as we went through that recession in the early 2000s. They came back and tightened to about 5%. Going into the financial crisis, cut rates to zero. They remained there for a long time, and they finally got rates back up to around 2.25%. So the question is, this tightening cycle, is this kind of maintain the trend of lower peaks and low, so how much further do they tighten? We're talking 2% raise? Is probably the other interesting thing is the last 4 tightening cycles, they ended it where the 10-year treasury was when they started. And that, if that holds true for this one, those rates would probably peak at about 1.8%. And there's a number of issues. So I don't think that they will go to some of these higher interest rates that we've seen. There's a number of things that will keep this down. First of all, this is what we call the yield curve. So how it looks when you have, you buy, obviously the longer you go out in the term of a loan or a fixed income instrument, the higher interest you're going to require for that. The center line is where we are now. So, they don't want to go too high, too fast to invert this curve, because that can lead to a lot of recessionary things. I mean, in one case, it's an indicator of where the market thinks the economy is going. So does it cause a recession? Maybe not, but I still don't think they want to do what they call invert the curve. And that's when you have short-term interest rates higher than long-term interest rates. So I think they're really kind of capped here at 1.8% over at least the shorter term. Maybe if it's a longer cycle, they can go higher, assuming long-term rates rise. But there's other longer term rates have other factors other than just what the Federal Reserve's doing. Those are driven by market forces. And right now, the US, even at 1.8% on a treasury bond, looks pretty good as far as the global bond market goes. I mean, Europe was negative rates from government bonds all the way from the financial crisis until just recently. We've seen more positive rates in Europe, but that's still well below. I mean, that still makes US bonds look quite attractive. So there's always going to be demand for US treasuries if they have rates that much higher than the global fixed income market. What does that mean for stocks? I'm sure everyone's interested in how that affects markets. So obviously last year was an extremely good year for the S&P 500. Not necessarily that great for all stock markets, but the S&P 500 up 28.7%. Growth and value both did well. International stocks, only 7.8%. And that's actually not a bad number. It's just doesn't look that great compared to US. Even Russell 2000 small cap stocks, those are usually the growth engine. They didn't even keep up. And obviously the tough market for bonds with rising interest rates, rising longer term interest rates pulled bond values down. So the bond index, the Bloomberg US Ag, lost about 1.5% through the year. And this is, the S&P for the last 25 years or so. That sharp angle up, ironically, looks a lot like demand for goods. We had a 102% increase off the bottom in 2020. So, obviously a huge and very rapid run in prices where, prior to that, it was much more gradual. We'd have 400% increase from the bottom of the financial crisis to the beginning of the COVID crisis. But that was at a much more measured pace. And we even did have a bear market in there in 2018 where stocks were down. But, overall, we think of the bear market kind of going to all the way to that 34% drawdown we had in early 2020. So pretty sharp tick up, and we've got more on valuations on the next page. So currently, we look at thumbnail valuation is what we expect stocks to earn, and when we stocks the market, the S&P 500. So all 500 companies, the sum of those earnings, and we divide the value of the S&P 500 index by those earnings, and we get a multiple. We can also look at individual companies on a multiple, but when we look at the market collectively as the S&P 500, we're at 20 times forward or expected earnings, which is higher than average, but it's not as high as it has been. Certainly in the tech bubble in the late 90s, we got up to that 24, 25 range. And even as recently as about a year ago, we were in that 22 range. So it's high on, it is the average, 25-year average is about 16 or so. So we're elevated, but not dramatically so. And we're in a good economy, so you'd expect we would be above average in a good economy. Probably on every metric, though, whether you're looking at the price to book, the dividend yield of stocks, the cash flow yield of stocks, we're all a little bit elevated, with the one exception is if you compare stocks to bonds, stocks look actually quite cheap. That's because bonds are probably the most expensive asset class that we follow. So on that standpoint, we're attractive, but the risk is, of course, that the bonds interest rates go up and bonds start to look more attractive because they're paying a higher interest rate, which would then make stocks look more expensive relative to bonds. So the interesting thing is, despite almost 28% increase in the value of the S&P, valuations still fell. And that's because the earnings increased by more. They increased almost 35%. So as a result, that price to earnings multiple, the denominator increased more than the numerator. So the actual ratio is lower. So stocks look cheaper on a straight price earnings metric than they did a year ago. And when you see that, these blue lines are estimated earnings. So the green line is actual 2020 earnings. The blue line is estimated 2021 earnings. The only thing we're still waiting on, there's still an estimate because we don't have all the fourth quarter numbers in yet. But so that estimate's probably pretty accurate. And then we still continue to see some growth. So 2022, we expect more growth, and these are analyst estimates. So 2023 are also expect some growth. Obviously, less certainty on those predictions because there's a lot that can happen between now and then. But we do certainly expect another increase in earnings because things are improving economically and prices are going up. So that helps in a lot of ways. And when we look at the contributors on the right side to appreciation in stocks, the green line is the price growth. So we've had earnings growth at this line, so exceeding the price increase of the S&P, which means the blue line valuations, they're falling. So what we've done really is just pulled forward the earnings recovery in the U.S. economy. So instead of a typical recession where stocks fall with the economy, and we're trying to, over the next several years, as earnings recover, stocks recovered this time instantly, and the earnings are finally coming along. So that if stocks stay the same price, the valuation will start to look more like average stocks. And, there's a lot of concern. Well, interest rates are going up. Does that put pressure on stocks? Well, it does add to volatility. Certainly there's no question. And we've seen that over the last, as this year started through January, earnings have come out. They've been really good. So that's kind of given some support to market the last few weeks. But, it does add to volatility. But historically, or at least the early stages of a tightening cycle have been pretty good for stock markets because it means we're in a strong economy and we're not talking about interest rate levels that are going to actually slow the economy or hurt companies. So this chart shows on the left, following the beginning of a interest rate hike cycle, the average return for the next 12 months for stocks is 7.3%. Well, that doesn't sound so great compared to 28%, but it's still pretty good. And I think, any kind of appreciation we can get would be welcome. It's just a kind of a similar looking chart, but just to show that those green dots are, what happens to valuations as interest rates increase. It's not until you get to that 3% level that stocks have a negative correlation with rate hikes. So if you go from 0 to 1, there's probably some appreciation there. Once you get to the high interest rates, then people start, mostly concerned that the Fed's actually going to put the economy into a recession. People pull back a little bit. Bonds also look more attractive at higher rates. So that's why you get that longer term negative outcome from stocks as we get to the higher rate environment, but we're certainly not there yet, and we don't expect to get there this year. And in that higher inflation environment, this is GDP, which is gross domestic product, obviously, but it's highly correlated to CPI. So once you get increasing inflation is actually good for corporate earnings because they have pricing power. So, take, for example, a consumer goods company. So you're selling detergent, you're really not going to sell much more volume than the population increases. It's not like someone's coming out with a great detergent. So you have pricing. And the last 10, 15 years, those companies have struggled because they haven't been able to pass price increases on to the consumers. That's changing. So that is actually helping profits. They do have to deal with some input price inflations, but that, is manageable. And so we do expect to see some higher profits. The question is, what's a negative during higher inflation environments is valuation. So we're seeing higher profits, but do those PE multiples fall? And they do at some point. So that's what we need to watch. But this just shows inflation levels compared to valuations. So 0 to 2%, the average multiple over the past 70 years has been 18 times. Even 2 to 4%, still up there, 17.4 times. So as long as we stay within that 4% range, it's not going to have a significant impact on stock valuations, and we do get some earnings growth. So it can be fairly moderate. Inflation is probably a good thing for stocks because they are growing earnings. They benefit from higher prices. So it's not until you get to these higher inflation levels, even 4 to 6% isn't the worst thing. These 6% plus that we saw in the 70s and 80s, that starts to hurt stock prices because companies can't keep up. You're also getting pretty good interest rates from bonds. So that's where we start to worry about things. But I don't think that's in our future. I think we're going to be well below that. Concentration within stocks. So we've seen, we talked about this in 2020, where you had a handful of large tech companies make up like 30% of the market, and they're currently, and that dipped a little bit, but it has come back up. So so the top 10 stocks make up 20% of their 30%, excuse me, of the S&P 500. And they also have higher multiples. So this is the multiple, that kind of really came up in 20, dropped off. It's still a pretty high. Those are the most expensive stocks in the market. They make up 30% of it. We're able to justify it because they contributed to also an outsized portion of the earnings, but that's starting to change. So, and the interesting thing is last year, about 40% of stocks were trading below their 200-day moving average at the end of the year, which means those stocks were at or near their lows for the year, despite this huge return for the S&P 500. So the returns we're seeing have been masked by just a handful of large stocks that make up, it tends to be these techy, growthy names that have high valuations and are making up an outsized portion. Now, higher inflation is a risk for those names because people buy them. Not people buy a Tesla not because they think they're excited that they're going to make $10 this year. They're excited they're going to make $100 in 10 years. But if inflation is 0 to 2%, $100 in 10 years is worth pretty close to $100, and it's worth $80. If inflation is 4%, it's worth quite a bit less. So those stocks are less attractive in a higher inflation environment. People are more interested in things like consumer companies that you're buying that for their current cash flow. They're generating high cash flow now and they're able to charge more. Banks are another part of that. With interest rates going up, banks benefit because they're charging more for loans. And what they charge for loans goes up at a much more rapid rate than what they're paying on deposits. So those are the kind of companies that do well in inflationary environments. This regime that tech and growth has dominated over the past 15 years or so. Really the only time it hasn't is once the tech bubble crashed in 2020. That may be obviously there's still going to be a lot of attraction for those high growth tech companies, but it may make some of these more standard, what we call value companies, look more attractive on a relative basis. How do we protect against inflation? There's some asset classes that just do better in inflationary environments. It's not horrible for stocks. The blue line is, performance during rising inflation, and the orange is decelerating. So stocks certainly do better, but there's still positive returns in rising inflation environments. The biggest two defensive sectors are commodity futures and gold. Problem is their long-term performance is poor and they're highly volatile. So the risk-adjusted performance is probably worse than anything. And you do get, sharp declines if you see a drop in inflation, which we are going to thinking that is likely to happen. So we would rather own things that like actual companies. So rather than commodity companies, things like infrastructure businesses, real estate, and natural resources and infrastructure, people that are still generating money. To get some current questions on cryptocurrency, cryptocurrency is an investment. It's kind of hard. Where do we get the valuation? Someone asked. It's essentially pulled out of thin air. It just really depends on supply and demand. There's no underlying intrinsic value, which is not necessarily a problem because gold is essentially the same way. Other than some jewelry demand, it's really just speculation on where the economy is going. But unlike gold, cryptocurrencies are hard to fit into a portfolio because they seem to be more of a leveraged bet on growth stocks and don't have a lot of diversification benefits. So that's not how we build portfolios. It makes it a challenge. This is the Fed balance sheet. We expect it to, they are ending quantitative easing. So we expect this to fall. That could be a headwind to longer term bonds. We could see rise in interest rates, but the Fed is actually a small purchaser relative to the whole investment universe. So we don't think all that falling the balance sheet will reduce demand to some extent, but we don't know that by itself can raise longer term interest rates. And just these are bond markets. We need to go too into these, but we are concerned about bonds in a rising rate environment. In many cases, we own individual bonds, so we've held on to those because they continue to collect the interest that we've locked in when we bought those. It's now what do we do with the maturities? So we're going into other areas, and I'll let Tim address that one. So the outlook, I think the biggest problem for stocks is not the economy, it's not inflation, it's the fact that we pulled in those valuations ahead of schedule. So valuations are a poor predictor of short-term performance, but a good predictor of long-term performance. So where we're at about 20 times earnings, you see that chart on the left, you would expect the next year return to be anywhere at the high end, about 40% to the worst level of maybe minus 20%. So that's quite a range, and very low correlation to valuations. But that chart on the right there is the 5-year number. And you can see when we came into this several years ago, we were kind of in that 14, 15 times earnings, and that would show an average 5-year annualized return of about 20%, which is pretty close. I mean, we're in those high teens for the last 5 years. That number drops quite a bit for the 5-year outlook when you're at 20 times earnings. So kind of in that low to mid single digit range, I think is a more reasonable expectation for stock returns over the next 5 years. At least in the US, that's the S&P 500. Where we do think there's much more value is outside of the US and international stocks. This is the ratio of basically the discount of stocks outside the US to US stocks. Typically, it's about a 13% discount that international markets trade at to the US. And there are reasons for that. Tech and growth make up a bigger part of the US markets than other markets. So you're not going to get those same valuations. But this is an extreme discount. And that discount, despite the earnings numbers, look pretty similar. The US grew 50% last year. That's expected to be 9% this year. But we go to Europe, still positive growth. So there's no reason for that huge discount other than, Japan 10% next year. There's no reason for that discount other than, I guess US investors just felt more confident that the Fed was going to support markets until we got through this, until earnings recovered, in which they did. So we just think other markets have been slower to recognize that, and they will over time. So we do like stocks outside of the US somewhat better than US ones. So in conclusion, we think inflation is here to stay, but will fall to a more sustainable level by year end. I think a sharp reduction in stimulus and negative sentiment will slow the economy. We revert to that growth trend of 2%. We do think the backlog will clear at some point this year, and surpluses could put deflationary pressure on some parts of the economy. Pricing and services, as we said, will likely increase as spending shifts and labor markets remain tight. And growth will not slow enough to cause a recession this year. 2023 could be another story, but we'll address that at the next economic outlook. And stocks in the US are priced in the earnings recovery. We'll need time to catch up. Moderate inflation and low interest rates from low levels may increase stock market volatility, but should not hurt long-term returns, and bonds are risky in a rising rate environment. So I think I have spoken for long enough. I'm going to turn it over to Tim before we take questions.
Great. Thanks so much, Steve. That was a great outlook for us. I'm going to share my screen. Just one moment. All right. So as far as alternatives go, this is an area that we've seen significant growth in our client portfolios over the last few years, and an asset class that Steve and our investment committee has spent a lot of time evaluating, looking for new alternative fund options. First, I'm going to just spend a minute explaining, what exactly these are and why we want to own them, and then share a couple slides before we turn it over to Andy to drive the Q&A, Andy and Abby. So first of all, what are alternatives? Really, we view this as a broad category of investments outside of traditional stocks and bonds that may offer similar return characteristics of each. These may take the form of mutual funds. They may gain exposure to currencies or macroeconomic trends. A lot of times they'll involve some form of stock optionality so that you're protecting against the downside of a major stock collapse. Other times, and this is a really growing area for our clients, we can gain access to the private markets. So private equity, private credit, infrastructure investments, and also real estate, which we've touched on. Advantages, the biggest one is that they don't move in sync the same way that stock market valuations do, or that interest rates, as they rise, that puts pressure on fixed income. Alternatives can provide a smoothing effect to the overall portfolio without susceptibility to some of those headwinds that are on the horizon, maybe not dramatic risks, but certainly possible risks that we do see and that Steve outlined. There are opportunities for higher yield with these alternatives, and really overall volatility lessening effect is those are the biggest points. Taking a look at the private markets just quickly, we are investing most of client assets in the public markets. And as you can see, the small yellow dot here represents the number of companies in the US that is publicly traded. So that's maybe less than 5,000 in this country. We're talking in the tens of thousands globally. If you think about the private markets, we expand the universe of investment options. Just in the US, this chart suggests 7 million or more private companies. So what we like about this space is that it really expands the market opportunity and the universe for our clients dramatically. This suggests that over time, over the last, say, 40 years, we've seen an increase in the age of companies when they decide to go public, and also the size of them. So there's a lot of growth that's taking place before a company goes public that private investors can benefit from, that we have not been able to participate in when we only invest in publicly traded stocks. And this avenue for us in alternatives can change that, which is an exciting opportunity. So that's equity. Now turning to yields and the debt side. This is a graph that shows what current yields are in US Treasuries, the 10-year in the red. You can see here under 2%. And then some of these other alternative asset classes that we've touched on, real estate, infrastructure, and direct lending, all of these offer much higher yields. A lot of times they offer inflation adjustments in the rental agreements. With direct lending, there are variable rates involved in a lot of those debt instruments. So these are great ways for our clients, many of whom are retired and depending on income from the portfolio, to generate higher levels of cash to meet their spending needs, even as inflation starts to increase. And then finally, there are some caveats that are important to note. Alternatives often come with some liquidity constraints. So they cannot be bought and sold every day the way stocks and bonds can. They may have some specific disclosures or additional subscription paperwork for us to work with clients on. And despite their advantages, we really view this as a complement to traditional stocks and bonds, not as a full replacement. There are always going to be reasons to own, our traditional assets. But we also feel like, given today's environment, this is a really attractive area for our clients, and we're happy to add them to our client portfolios. Andy, I'll turn it back over to you.
Great, thank you, Tim. Thanks a lot, Steve. I thought that was a great presentation. I see one question in the table here, but I also know that some ones were submitted earlier that perhaps you want to address. One from a participant is the current rate of inflation a problem for the economy, and how can we as individual investors protect our investments for the longer term?
Well, I mean, the current rate at 7% would be a problem if it stays at that level. But, we don't think that that's likely. I mean, you've had a huge year-over-year increase. I mean, think about energy prices. So in 2020, light sweet intermediate Texas went negative $60 a barrel. So it's, clearly in 2021, it's going to be more expensive when you can go out and drive places. So you've had a sharp uptick year over year, but that should moderate. So we don't, we don't see it as a problem at the current levels. If we were concerned that you're going to stay at that 6 to 7% range, you could get more aggressive into commodities such as energy. But we think that is add some risk for kind of a non-inflation or a lower inflation environment. And then think, some of these ways we presented as far as real estate and infrastructure and even stocks and natural resource companies provide protection, adequate protection, but you still actually own a company that's producing cash flows and a better investment option over the longer term.
Okay, great. Another question is, we hear a lot the reasons for rise in prices from COVID to inflation in regards to fuel prices. What's causing this? Supply issues, refinery issues. I know when I filled up my car this morning, it was over $5 a gallon. And just not very long ago, it was in the high $3. So
yeah, I mean, it's just a big increase in demand for fuel, and particularly in the form of gas. And it's interesting that the last 20 years or so, or more specifically the last 10, since the U.S. has been energy independent, especially that the amount of oil wells closely tracks the price of oil. They've been slower to come back. So that's probably, that's part of what is creating the higher than expected price in the barrel of oil. But they will eventually come back and start producing more oil if these prices remain elevated. I think there's a little bit of skepticism among the drillers that these prices are going to maintain. So I think there's some hesitancy to invest in more extraction, but the way that it's done these days, it's very quick to put up an oil well in some of these shale oil fields that most of this stuff, new incremental supply is coming from. It's not like we had to put up a deep sea rig, which takes years. It's pretty quick. So I do think, into this summer, if we see oil prices stay where they're at, you're going to see a lot more production.
And here's a geopolitical question. How would Russia invading Ukraine affect the stock market?
I mean, it'll probably add a little bit of volatility over the short term. We've been through a number of geopolitical crises, and the long-term impact is pretty limited, especially in something like the Ukraine is not a big piece of the global economy, nor is Russia. So I don't see a meaningful impact over the course of the year.
Okay, and the last question really speaks to our process of rebalancing portfolios. How do we do it? When do we do it? What are we looking for?
Well, we rebalance quarterly. So every portfolio we go through once a quarter and make sure everyone's kind of in line with the guidelines. One that they presented us as far as stocks versus bonds weighting. And then, as we get together as an investment committee and decide on allocations to U.S. large cap, small cap, international, same thing on the bond side. What we've done more recently on the fixed income side is increased allocations to things that have higher yields or maybe adjust with rising interest rates, like loans, for example. Those are based on floating rates. So we've added to those. And as rates go up, we would expect that part of the market to perform well. So, that's part of the process, as well as we're moving money from, traditional fixed income to other parts of the market.
Great. Well, I think that pretty much wraps it up. Thank you, Steve. Thank you, Tim. Thank you, everybody who's been involved in this presentation. I'd like to thank everyone who has joined today's presentation. In a few days, this recorded presentation will also be available on our website. If you have any questions, please let us know. We thank you for your continued support and want you to know that we are here to serve you. Please be well, stay healthy, and thanks again for your attendance today. Goodbye.
Thanks, everyone.